Hey everybody, back with another ETF review, and today we're going to be looking at DGRO, or the iShares Core Dividend Growth ETF. Wanted to look at this for a couple of reasons. I got a nice suggestion for it, and it seems very similar to SCHD, which I often use as the gold standard for dividend ETFs. So without further ado, let's get on into it. Starting as always with the expense ratio for our ETFs, we can see here that we're sitting at 0.08%, very, very low, under 0.1%. This is one of your ultra low cost passive funds. For every $10,000 you put in here, you're only going to be charged about $8 a year, so very low fees there, nothing to be worried about in that department. From there, since we're talking about dividends, let's go ahead and look at what the yield is currently sitting at. And as we can see, our yield is right at about 2%. So we're doing, better than the S&P overall, which is sitting somewhere between 1 and 1.5% depending on the day. But we're not doing as well as a lot of other dividend ETFs. For example, SCHD is around 3%. A lot of other dividend growth ETFs are somewhere between 2.5% and about 3.25%, while some of your just income focused stock ETFs are sitting somewhere between 3 and 5%. So this is definitely on the low end in terms of yield, but as we know, yield isn't everything. So let's see how they're doing with that yield, how things are going. Looking at the distributions, we can see that going back to our inception around 2014, they were paying out about 16 cents a share. And of course, because it's an ETF, that's going to fluctuate because of when the companies pay. But we can see that today we're getting really somewhere between 23 and 26 cents. So there definitely has been appreciation here. The companies that the fund is invested in are definitely increasing their dividends over time. And as we can see from their investment objective, that's what they're looking for. U.S. equities with a history of consistently growing dividends. I haven't been able to find a ton on what their exact way of developing the index is, what their exact criteria is, but it is companies that are growing their dividends. Moving on from there, let's go and take a peek at those companies, see what the portfolio looks like. And as we can see here with the top 10 holdings, we've got a lot of known names. I mean, you've got Microsoft, Apple, Pfizer, JP Morgan, Procter & Gamble, Home Depot, Johnson & Johnson, Verizon, Merck, Broadcom. These are all S&P 500 companies. These are large cap companies that happen to be paying dividends, things that everybody knows about. We can see that really their top 20, 30, 40 or so are all S&P 500 companies. Then as we go deeper into the list, we get companies that aren't S&P 500 but are still often well known. I mean, you got things like Aflac, Allstate, so on, Intuit, which is, a Dow company, so on and so forth, Best Buy, everything like that. So these are large cap companies, things that are known, things that we aren't expecting to have any issues with in terms of the big picture. They aren't going to go out of business anytime soon, and they happen to be raising that dividend. Looking at the breakdown of the portfolio, there are a few concerns here. We can see that it's very heavily skewed towards IT, financials, and healthcare. When I'm looking at a dividend ETF, I'm looking for something that I can be sure that I'm going to be able to consistently get those dividends over time. So I like to see a lot more in terms of communications, consumer staples, industrials, and materials. These are things that even if there is an economic downturn, these things are still going to have to be produced, stuff like that. When it comes to IT, financials, if there's a market crash, you can really expect 40% of this fund to really suffer, because those are the sectors of an economy that when the market crashes tend to have the largest crash going over the last few decades, how things have tended to go, excuse me. But on the flip side of that, remember, these are all large cap companies, so these aren't things that are likely to go out of business. While they may suffer a downturn when an economic downturn happens, it should be as prolonged as the economic downturn is. It shouldn't be anything crazy. Still, I would like to see some more equal exposure in the breakdown, but that is what it is. Moving on to the actual performance of the fund, going over for like the 1 year, 3 year, 5 year, the fund is only 7 years old, so there isn't a ton to go off here, but we can see that since inception it has averaged about 12.5% a year, which is better than historic returns for the S&P 500, but looking at like the last year to 3 years, especially the last year doing only 29% when the S&P is, skyrocketed, definitely not doing as well, but still doing okay. Then we'll move over to our back test, and for this one we will have, of course, our DGRO in our first portfolio. In our second one we'll have SCHD, the gold standard, as I said, as a direct comparison, and then we'll have VOO as our S&P 500 control. Going down and looking at our graph, going back to the inception of the fund at the end of 2014, we can see that generally they've all moved roughly together. Excuse me, I keep DGRO. I keep trying to say DRGO. I want to say doctor for some reason, but DGRO is always roughly at the bottom, or has been since really 2018, but only by a little bit. We really only saw some divergence happen when we had the crash. So, you know, nothing crazy there in terms of how different they are. And as we can see, we're ending up here. If you'd have put in about $10,000 back then, really with SCHD, you'd be almost the same, only a couple percentage points off over those 6 years, whereas if you'd have been in the S&P, you would have done, you know, a little bit better, almost about 10% better. So, you know, not nothing. Looking at it, it does by almost every metric seems to be doing a little bit worse. It does have an average. It does have a worst year average of the lowest, but also has the highest max drawdown. It has the lowest total return, but has the mid of the best year returns. So it's very much, it's doing worse than the others, but not in a way that's particularly significant. You wouldn't, unless you're investing, you know, millions of dollars into this, you aren't going to see a large change in what your total return is going to be. You know, if you were at 10,000, if you were at 100,000, this 2-ish to 10%ish isn't going to be a huge thing over this this short of a period, I should say. So really it's about the same as the others. There's not a huge difference there. Going into, you know, who is this fund for? Should you be looking at it? From an appreciation standpoint, it is the focus of the fund. As we saw through the distribution history, it has been increasing its distributions over the past 7 years of its inception because the underlying companies have been increasing their distributions. So that is definitely, if you are an appreciation investor and you like this fund, you like what it's doing, you like the holdings, things like this, this could be something to look at. It is definitely what the fund is focused on. From the yield side of things, there's just not much here. 2% is really the base bottom of what you're looking for in terms of yield, and this is still not quite there, just sitting under 2%. And because this market is so overpriced, finding yield is very difficult. If there is any kind of market pullback and it's not crazy and you're able to still invest, this might be something to look at there with that yield jumping up as the price goes down. So keep that in mind. So overall, what is DGRO compared to its competitors? What is it? Should you be looking at it? From the look of things, now it is very young, it's only 7 years old, but it seems like it is a slightly worse version of SCHD. It's looking to do about the same things in terms of dividend appreciation, but it's doing just a little bit worse, as we can see from our graph and from our performance. Not by a ton, again, only a couple percentage points behind. So, you know, think about it that way. The other thing is, with SCHD having a 1% higher yield, your returns are going to be a little bit higher in terms of capital appreciation with this, whereas opposed to SCHD, your returns are going to be a little bit higher in terms of the income. So if you're looking for income but not as much while still trying to get capital appreciation, this might be something for you, depending on, you know, things like your tax situation, stuff like that. This might be an alternative where the yield doesn't matter as much to you. You're looking more for those capital appreciation returns. Compared to the wide market, this could be something that you might substitute for something like VOO or SPY, because you want to get similar returns. Again, your overall returns are going to be a bit lower, but you're going to be getting a slightly higher return in terms of income. So, you know, if income is what matters to you, if, you know, you're retired, semi-retired, just looking to make more in terms of income, this might be something to look at, because you're going to be getting those returns in the form of cash flow as opposed to the form of capital returns. So, you know, it occupies a weird spot where it's not doing as well as the others, but given your particular situation, it might be a slightly better choice, because your income versus capital desires are different than other people's. Yours are very particular in terms of how much you want your growth to be in terms of income as opposed to in terms of capital gains. So think about it that way. It might occupy, you know, that spot for you. It's definitely something to look at. If you're looking at something like SCHD or other income appreciation, dividend appreciation funds, this is definitely something to look at. It's a good thing to compare other things to in terms of how they're performing, looking at the portfolios, stuff like that. Definitely not a terrible fund. It's doing its job. those quarterly distributions are increasing while you are also getting some form of capital appreciation. So again, not terrible, just seems to be a little bit worse than its competitors, but not by a lot. As always, I hope this helps, and thanks for watching.